Google, with its massive technical depth and AI focus, is being called potentially the most profitable Magnificent 7 stock, and today we will find out in our 10-minute stock snack. After spending hours analyzing 10 years of financial on Google, the biggest targeted advertising company, here is the 2 key insights I find out. I'm going to blend the insights in this 10 minutes video for you to snack and go. At Stock Snack, we make stock analysis simple and clearer. Here is the 4-step framework we use to analyze every stock. First, the price projection. We identify the stock's profit potential over the next 10 years. Second, the benchmark test. We compare that potential profit against the market giants, the S&P 500. Which is better? Third, the business model. We analyze the company's story and its revenue source to see if the profit is sustainable. Fourth, the financial health check. We run the numbers to expose the underlying risk and strength. By the end of this video, you will know what is the profit. Is the profit good or bad? What is this company doing? And if it is financially healthy. Okay, let's start with the price projection. We are using 3 approaches from their profit, from their cash flow, and their dividend. Right now, the price of Google is $323. First, estimate Google stock price 10 years later with their profit. With the growth of Google, we think the price will be $1.2K 10 years later. I then do the similar analysis with cash flow and dividend. The detailed calculation, find it in my channel. And we average all 3 analysis up. Google will worth $1.2K, which is 2.7 times return in 10 years' time, or estimate CAGR of 14.12%. The profit is more than triple the money you put in. To know if it is good enough, we will compare it with the market S&P 500. S&P 500, the 500 largest U.S. company. It is currently priced at $617, and we estimate that it will be $2,200 10 years later. This estimation is based on the last 10 years' growth, which also means the estimated profit on investing in S&P 500 is 2.5 times with CAGR of 13.35%. So, to conclude the price projection, Google, the biggest targeted advertising company, is bringing us profit of 2.7 times, with CAGR of 14.12%, and the S&P 500 is bringing us profit of 2.5 times, with CAGR of 13.35%. Therefore, we can conclude that Google, the biggest targeted advertising company, is better investment than S&P 500. Analyze stocks can be challenging. Therefore, I am leveraging on this site. Access historical data of annual reports in just one click. If you're into fundamental analysis, trust me, you will love it. You can find the link in description below. Next part of our framework, understand the business. 2 parts, the general information and the revenue source analysis. Starting from the general information. In short, Google began with Larry and Sergey in a Menlo Park garage. It grew rapidly by offering free services like search and YouTube, fueled by user data, which powered targeted ads, the engine for their massive expansion and moves like buying Android and forming Alphabet. Now, the focus is AI, Gemini models, agentic systems, and multimodal tech. This presents huge opportunities and risks from competition and regulation. Google's advantage is its massive moat, search dominance, cloud ambitions, and deep data. Their direction is clearly AI first, making the key question whether they can maintain their lead. Next up, the revenue source analysis. Google's revenue backbone remains search, almost 1/2 the revenue, and ads everywhere across platforms. However, the major growth story is Google Cloud, which is growing the fastest by helping companies with data storage and artificial intelligence. Subscriptions and devices, YouTube, Premium, Pixel, Android, are also showing surprisingly strong growth, indicating a move away from total ad reliance. While search pays the rent and ads keep the lights on, cloud is considered the future that could change Google's story. Right. Last steps of the framework. The financial health. For Google financial statements, the combined financial score is good, with 15 metrics scoring well out of 22 total metrics. Breaking that down, the balance sheet looks good. We checked 7 metrics there, and 5 of them came back with a good score. The income statement also looks strong. We reviewed 9 metrics for the income statement, and 8 of those metrics received a good score. And lastly, we saw a bad score for cash flow. Out of the 6 metrics we checked for cash flow, only 2 metrics got a good score. In conclusion, while the company presents a fortress-like financial position, boasting high cash reserves, strong profit margins, and minimal debt, it's not without its challenges. Specifically, we've seen historically low share buybacks, a potentially scrutinized low tax rate, and massive capital expenditures that ultimately cause the reported net income to outpace the actual operating cash flow. To go through the detailed financial statement analysis, check out the other video in my channel. The conclusion: buying Google, the biggest targeted advertising company stock. By the profit-wise, Google can beat S&P 500. At the same time, it is having good financial health. Now, the analysis is complete. Once again, if you need tools for your investment strategy, give a try on the site I use. Link is at description below. They provided sufficient free tools for you to work around. If you ever want an upgrade, promo code is StockSnack. Institutional grade data with less than $1 a day. One day, one stock. See you again at StockSnack.